Greetings and welcome once more to another video. I want to talk about the market maker business model, and it's another model on price action or module, if you call it that way, that will be able to enable us to trade based on one side of the marketplace, either the sell side of the curve or the buy side of the curve. And we're going to focus on the patterns. Now, the market maker business model is also called the reflection pattern, and we're going to see that why it bears that particular name. Whatever is showing on the right side of the curve is more of a reflection, not to picture perfect, but more of a reflection to whatever happened on the left side of the curve. The market maker business model can as well be abbreviated as the MMXM, whereby the first M stands for the market, the second M stands for maker, then X is a placeholder for either the buy or the sell, because we have two models, the market maker buy model and the market maker sell model. And of course, the last M stands for the model. So the first M is the market, the second M maker, the X is just a placeholder for either the buy or the sell, then the last M is the model. Now we have two instances of the market maker business model, and we have the market maker buy model and the market maker sell model. So the market maker buy model is the MMBM, and the market maker sell model is the MMSM. Now, it's called the market maker buy model because we're going to focus on the buy side of the curve with anticipation of, the original consolidation, which is the point of liquidity being taken out. So we're going to work with the buy side of the curve. We are focusing on the buys for the market maker buy model until the business model has been completed. And the market maker sell model, which is abbreviated as the MMSM, we'll be able to be focusing on the sell side of the curve. We'll be looking for bearish scenarios and sells, working with one side of the curve, which is the sell side of the curve, with anticipation that the original consolidation, which is the point of liquidity below the marketplace, will be cleared. Now, when trading the MMXM, either the market maker buy model or the market maker sell model, we focus on the pattern formation, how the pattern looks like. And we're going to see how the pattern looks like. Now, the market maker business model essentials. In the market maker business model, we have three important elements. Yet as much as we have other elements like the low risk sell areas or areas of redistribution and areas of accumulation, for that particular model to hold a lot of weight, we're going to focus on three things for now, and I'll offer an amplification when it comes to those particular low risk sell and buy areas. Those particular areas, they tend to be housing the reclaimed blocks, which will be able to be capitalizing on the other side of the marketplace or the curve. But for now, these are the three areas or the three essentials that you'll be able to focus on. We have the original consolidation. After the market has formed a particular original consolidation, it can form certain areas, and we're going to see that in a few. The market will be able to form the smart money reversal. As the name suggests, it is the point of reversal. And the reversal can occur at a significant PD rate, can be above an old high for a market maker sell model or below an old low for a market maker buy model, or it can dive into a bearish order block for a market maker sell model or a bullish order block for a market maker buy model. or any other key reference point, like the mitigation blocks, maybe closing into a gap or a fair value gap. After the smart money reversal formation, we don't strive to capture the tops and the bottoms. We wait for a significant shift in market structure. That is when we'll now be on one side of the marketplace with anticipation of the original consolidation being cleared. So we'll be able to be focusing on one side of the marketplace as we wait for the original consolidation to be cleared. Hence, the third area is the clearing of the original consolidation. And when the original consolidation has been cleared, which is the point of liquidity, we close our positions, because three things can ideally happen. Either the market can give us a complete reversal, or it can consolidate around a particular area, or it can continue with a particular trend direction. So the best thing is for you to close your positions and wait for the next setup to form. Now, despite having other levels of the market maker business model, the most important areas are the ones stated above. The market maker business model, MMXM, will help us to trade on one side of the curve, like I mentioned. We'll be focusing on either the buy side of the curve for a market maker buy model, or the sell side of the curve for a market maker sell model, with anticipation that the original consolidation will be able to be cleared. A market maker buy model is a buy model because we will focus on the buy side of the curve with anticipation that the market will clear the original consolidation above the marketplace. Whereas a market maker sell model is a sell model because we'll focus on the sell side of the curve with anticipation that the market will be able to clear the original consolidation that is residing below the marketplace. Now, when it comes to the original consolidation, it's the point of liquidity, and the market typically tends to be moving to where orders reside, and the orders reside in the form of liquidity. And where does liquidity reside? Of course, the whole marketplace is booked, but you can be able to work with specific areas like swing points above an old high or old low, above a short-term high or below a short-term low, previous day's high and the previous day's low, among other areas. So it doesn't mean that that particular original consolidation must be a clean, clear, visible consolidation. It can occur with even a single swing point. The idea is that it's a pool of liquidity. With or without the consolidation, it can even give us a single swing point scenario. The original consolidation for the market maker business model. Now, this is the baseline point of liquidity. Note that it does not have to be a prolonged consolidation. It can be formed by a single swing point. So if it occurs with a consolidation, a prolonged consolidation, it's okay. But again, it doesn't have to be formed by that particular prolonged consolidation. A single swing point is still a valid one. The idea is that it's a pool, it's a point of liquidity. That is what the market makers will be able to be targeting to deliver. Once the smart money reversal forms, price will target this area to clear it, making it the primary draw on liquidity. And again, like I mentioned a few minutes ago, we are not interested in capturing the tops and the bottoms within the marketplace. That is none of our business. But after the smart money reversal formation, we wait for the significant shift in market structure. That is when we'll be able to be on one side of the marketplace, depending on the context, either the sell side of the curve or the buy side of the curve. Then we'll be able to be trading in that particular direction, in that particular side of the curve, as we'll be able to be targeting the point of original consolidation or point of liquidity for us to have the clearing so that this particular model can be complete. The original consideration is the point of liquidity. It can either be a buy side liquidity or sell side liquidity pool, depending on the model. And liquidity residing above the marketplace is called the buy side liquidity pool, whereas the liquidity residing below the marketplace is known as the sell side liquidity pool. The smart money reversal. Now, this is the exact turning point of the market. Price can reverse from any key institutional reference point, such as an order block, an imbalance of a value gap, below an old low or above an old high, or even at an optimal trade entry level. It depends on the context, so we work with whatever price is offered. But I actually like the reversals that originate from points of liquidity. In other words, after the market has taken out a low or a high, because it will be able to initiate a business program of the market makers. For a buy program is whereby the market makers will be able to buy below an old low, and a sell program is an instance whereby the market makers will be able to sell above an old high. So the reversal can originate from either institutional reference points, but I love the ones that emanate from points of liquidity. Following its formation, we look for a shift in market structure, or the SMS, to confirm whether we are on the buy side of the curve or the sell side of the curve, depending on the specific MMXM model. It depends, with either a market maker buy model or a market maker sell model. And basically, smart money reversal is the point of trend reversal. Now, at some point, I tend to be working with also the smart money divergence around the smart money reversal point. And smart money divergence is a topic that I'll be able to talk about and how we can be able to utilize it as a qualifying tool. So if it occurs and the macros are suggesting one side of the marketplace, and I've spotted that particular market maker business model, then it will be able to boost the odds again in my favor. Clearing of the original consolidation. This is the stage where the liquidity at the original consolidation is taken out. You remember the original consolidation? I said it's the point of liquidity. After its formation, the market will be able to form maybe low risk areas like the low risk sell or low risk buy, depending on the context. But the market has to give us the formation of the smart money divergence. After the formation of the smart money divergence will be on the one side of the marketplace after the shift in market structure. So we are going to work with that particular one side of the marketplace, targeting the original consolidation that was created initially. And that point is just the point of liquidity. So the third instance, or the third essential, point is this particular clearing of the original consolidation. It is the stage where the liquidity at the original consolidation is taken out. Upon clearing this level, the market maker cycle is considered complete, and we close our positions altogether and wait for the next setup to form. It is highly recommended to close all active positions at this point and wait for the next setup to form. And like I mentioned, three things can happen when the original consolidation has been cleared. We can have a complete reversal altogether, consolidation around the area, or trend continuation. It's advisable to close your positions and wait for the next setups to form. Now, the market maker business model with the order flow, or the MMXM with the order flow. When trading the market maker business model, it is best when you consider the high time frame order flow. Is the high time frame suggesting bullish price action, or is it suggesting bearish price action? And I gave you the idea that you can be able to begin from when it comes to the CO hedging program together with the seasonality aspect. So if the market is suggesting bullish price action, we can, try to filter the element of the market maker buy model because it's in sync with the predominant order flow. And if the market is suggesting bearish price action when it comes to the order flow, it is best for us to filter the market maker sell model, since it will be able to be in sync with a particular bearish order flow. And remember, these particular patterns of the market maker business model, it's fractal, since price itself is also fractal. It can occur in any time frame, either the daily time frame, the weekly time frame, the monthly time frame, the 4-hour time frame, the 1-hour time frame, the 15 minutes time frame, or the other intraday time frames. But for you to have highly probable conditions, I challenge you to work with the patterns or the model that is in sync with the predominant order flow based on the high time frame premises. So the high time frames of focus include the monthly, weekly, the daily, and 4-hour time frames. Focusing on the narrative of the high time frame will boost our odds. A highly probable market maker business model, of course, is the one that is in sync with the high time frame. Sorry, a highly probable market maker buy model is the one that is in sync with the high time frame bullish order flow. And a highly probable market maker sell model is the one that is in sync with the high time frame bearish order flow. And this is the market maker buy model. This is how it looks like. Now, it's a market maker buy model. Why? We're going to focus on the buy side of the curve. Before the smart money reversal has not been formed, we can't validate ideally that this is a buy model. So first, the market will be able to create the area of original consolidation. And this particular original consolidation, it's a point of liquidity. For this particular case, it's the buy side liquidity pool. And like I mentioned, it doesn't have to be formed by a prolonged consolidation, as it can be formed by even a single swing point. The market will be able to break down. For now, we can't validate and qualify this one as a buy model. So the market will be able to break down, give me an area of low risk sell, low risk sell, or redistribution. How many of them can the market give us? As many as possible. We work with whatever the market has offered. And for now, we won't be, working with these particular areas for now. But in further amplification, I'll be able to talk about these particular mid levels. So another one can be formed again. The market will be able to hit a critical point. It can dive into a specific area of reference, institutional reference point. It can take out an old low. It can react into a bullish order block or close an imbalance or maybe an optimal trade entry environment, and be able to create the smart money reversal. So when this particular smart money reversal has been formed, we don't do anything because it will be hard as a beginner to now validate if this is a buy model. We wait for a significant shift in market structure. A short-term high has to be taken out. After that particular significant shift in market structure, that is when we're able to work within one side of the marketplace. And which side of the marketplace will it be? The buy side of the curve. With anticipation that the market will be able to target this particular original constellation, which is the point of liquidity. Remember, the market will be able to be moving to where orders reside, and the orders reside in the form of liquidity. So after the shift in market structure, the market will be able to give us a low risk buy or accumulation area. We don't do anything. How many of them can be formed? We don't know. We work with whatever price is offered. And we don't focus on them for now. maybe another area of low risk buy or accumulation, or maybe another area. And we're going to look for trading opportunities in line with the time and price theory on one side of the marketplace, with anticipation that this particular regional consolidation will be able to be cleared. And that is why you can be able to see this particular area of clearing of the regional consolidation being higher, slightly higher than this area, indicating that the regional consolidation, this one, the point of liquidity, has been cleared. It's called a reflection pattern because assuming you have a mirror line dissecting right through the middle, the midpoint of the SMR, the smart money reversal, over here, whatever is showing on our right is more of a reflection to whatever, formed on the left. Not to exact picture perfect, but more of that. So this is a market maker buy model. We'll focus on the buy side of the curve with the anticipation that this particular regional consolidation, the point of liquidity, will be cleared. And when the regional consolidation has been cleared, close your positions, because like I mentioned, three things can happen. You can have a complete reversal to the downside, or the market can even consolidate around that particular area, or we can have continuation of that particular move. For us to be on the safer side, it's advisable that you close your positions and wait for the next setup to unfold. So it's a buy model. And you can be able to see an example, this GBP/USD chart. Now, initially the market gave me that particular original consolidation. This was a low resistance liquidity run. You can be able to see that particular pattern. I've not shaded the areas because I want to also to spot it with ease. But the market entered a period whereby it took out the necessary liquidity pool, giving us the smart money reversal. And you can be able to see the pattern is there. So once that particular smart money reversal has been formed, wait for a significant shift in market structure. This I was taken out with the body. Somebody will be able to use this one. It's okay. That is when we'll now be operating on the buy side of the curve now, with anticipation that this particular original consideration will be able to be cleared. And you can be able to see clearly that it resembles this particular pattern. So we're going to work on that particular side of the marketplace, the buy side, targeting buys now, with the anticipation that this particular original consideration will be able to be cleared. Once it has been cleared over here, close your positions. This is another example for the dollar index. Original consideration, the market gave me or gave us a low risk sell over here, another area, but took out that particular sell side liquidity pool, giving us the smart money reversal. After the smart money reversal has been formed, we wait for a significant shift in market structure. Somebody can be able to use this one, an aggressive trader. Another trader will be able to use this particular high. Another one will be able to use this high. But the market began by giving us those particular low risk buy areas or the accumulation phases over here. Another one inside this particular bullish order block, and we are operating on one side of the marketplace. Another area for buys, for longs, with anticipation that this particular original consolidation will be cleared, and it was cleared. And whenever it has been cleared, close the positions, because the market can give us a deep reversal or consolidate around the particular area, or it can give us a trend continuation. But the market even went further to the upside. So we were on the buy side of the curve, and we focus on that particular pattern. Market maker sell model. It was a typo. It should be the S over here. So the market maker sell model. This is how it looks like. Let me just zoom it out. This is the market maker sell model. The market initially be able to paint the original consolidation area. It's the point of liquidity. For this particular case, since the liquidity is below the marketplace, it should be called the sell-side liquidity pool. The market will be able to give us a rally, be able to give us a low risk buy. And like I mentioned, these particular mid levels, we don't focus on them for now, but I'll do that in further amplifications. So how many of these particular levels? We work with whatever the market has offered. The market will be able to dive into a significant institutional reference point. Maybe it has taken out an old high, or it has reacted inside a bearish order block, or maybe closing a range, or maybe an optimal trade entry. But we don't do anything. We don't capture the top over here. We wait for the shift in market structure. That is when we're going to be on one side of the marketplace. And which side of the marketplace will that be? The sell side of the curve. With anticipation that this original consolidation that was created initially will be able to be cleared. The market will be able to give us the redistribution levels. We don't focus on them. How many of them can the market give us? We don't know. We work with whatever the price has offered. So on the sell side of the curve, and can be able to see this particular area is lower than this one, indicating that this original consolidation, which is the point of liquidity, has been cleared, and that particular model is complete. Assuming you have a mirror line dissecting right through the middle over here, whatever is on the right is more of a reflection to whatever occurred on the left. Not picture perfect, but more of. And this is one of the things that I used. If you go to my YouTube channel, I sold BTC at some point in the previous years because we had a clear market maker sell model. So that is the original consideration that the market offered. Then the market will be able to create the support band reversal and the clearing of the original consideration for us to have a complete market maker sell model. So we have another example, USD CAD, 30 minutes time frame. The buy sell liquidity pool was taken out, even this one. The market gave us a smart money reversal. This is the original consolidation in the form of low resistance liquidity run signature. After the shift in market structure, we were now on the sell side of the curve with anticipation that this original consolidation will be able to be cleared. And assuming this is just a line that dissects right through the middle, is just giving us an indication that this is a reflection pattern. Can be able to see, assuming you have a mirror line dissecting right through the point of reversal over here, whatever is on the right is more of a reflection to whatever occurred in the left, not picture perfect. So the market gave us an area whereby we can be able to sell short over here, a redistribution level, gave us another retracement, another area of selling short, expansion, retracement, another area to sell short, expansion to the downside, retracement, another area inside this particular bearish order block, then completed the particular model. So we were on the sell side of the curve. And when it has been cleared, close your positions and wait for the next setup to form again. This is another last example. This is the NZD USD chart. The original consolidation, low risk buy, other areas of accumulation stages. The market gave us a smart money reversal point over here. This is the mirror line, giving us an indication that whatever occurred on the right is more of a reflection to whatever occurred on the left. Then the market was now on the sell side of the curve with anticipation that the original consolidation will be able to be cleared, and it was cleared over here. So these are areas whereby we could have taken our sells, and the market completed that particular market maker sell model. So basically we focus on that particular pattern, and like I mentioned, it is advisable, highly advisable, for you to work with a model that is in sync with the higher time frame order flow. It is very, very important for you to have a highly probable trade scenario. So this is how you can be able to be working with one side of the marketplace when it comes to the market maker business model. The buy model for buy side of the curve and the sell model for the sell side of the curve. And with that, I'm wishing the best of luck. Talk to you soon. Bye-bye.